Genesis HMAS deconstruction engine online.
For decades, the global economic order operated on a predictable binary. On one side, the People's Republic of China relied on an export-driven, state capitalist model. On the other, the United States anchored a decentralized, free market architecture. By 2026, that established baseline has collapsed. The two superpowers are locked in a systemic technological arms race, driven by escalating geopolitical friction. The targets of this friction are the foundational technologies of the 21st century: generative artificial intelligence and advanced semiconductor fabrication. To secure dominance in these sectors, the United States has initiated a peacetime deployment of sovereign capital directly into private equity markets. This maneuver discards the traditional American framework of short-term emergency bailouts. By taking persistent equity positions in private innovation, the U.S. is adopting the interventionist mechanics of a centralized command economy. The attempt to neutralize geopolitical risk through state-directed capital has dismantled the old macroeconomic borders, triggering a volatile structural hybridization of sovereign wealth. To evaluate the viability of any sovereign capital system, we have to audit the underlying funding pipelines. China finances its state corporatism through a highly mature system of domestic financial repression. The central administrative mechanism is the State-Owned Asset Supervision and Administration Commission, or SASAC. This bureaucratic agency exercises absolute control over the domestic banking apparatus. The state intentionally suppresses deposit rates, causing negative real returns for savers. This artificial wealth transfer siphons capital from private citizens into state-controlled banks. These banks then evergreen highly leveraged loans to prop up inefficient state-owned enterprises. SASAC maintains this structure deliberately. They accept profound economic inefficiency as the calculated cost of retaining absolute political and structural control over the industrial base. By continually taxing household wealth to shield underperforming corporations, the state suppresses the purchasing power of its own population. The mechanics of this arrangement force domestic demand into stagnation, trapping the economy in a low-growth deflationary loop. Without a robust domestic consumer base to buy its products, China pushes its massive manufacturing output onto international markets. This dynamic generates an annual manufactured goods trade surplus of more than $2 trillion, equating to roughly 10.5% of Chinese GDP. Yet a forensic audit of global balance of payment statistics reveals a massive regulatory failure tracking this capital accumulation. The International Monetary Fund relies on accounting methodologies that obscure the true scale of the imbalance. Using distorted custom-to-balance of payments reporting, the IMF deflates China's actual current account surplus down to a modest 2.2% of its GDP. The primary obfuscation tactic is an anomaly in the data. China reports a $150 billion investment income deficit, despite simultaneously holding $4 trillion in net foreign assets. Through these distorted export pricing models, China hides its capital accumulation, leaving global trade regulators blind to the scale of its deflationary export engine. The United States approaches sovereign capital from the opposite starting position. It lacks a high structural domestic savings rate, and it possesses zero compliant state-owned banks. Instead, the U.S. balance sheet operates with an annual fiscal deficit of $1.8 trillion and a cumulative national debt surpassing $36 trillion. This cascading balance sheet shows how any proposed U.S. sovereign wealth fund operates without a budget surplus. It must rely on explicit debt financing, issuing fresh treasury obligations to purchase strategic technology equities. Financing equity through sovereign debt introduces a negative spread hazard. It converts the world's benchmark risk-free asset class into a leveraged venture capital vehicle operating inside a high-interest rate environment. Furthermore, the U.S. targets a completely different kind of asset. While China subsidizes physical manufacturing, the U.S. is buying into generative artificial intelligence, entities that function as hyper-expensive financial capital furnaces. The unit economics of large language models are highly constrained. Even as developers scale their annualized revenues past $20 billion, escalating inference costs are compressing their gross margins from 40% down to 33%. The result is immense cash incineration. Leading AI developers are projected to burn through $218 billion between 2026 and 2029. This recursive loop diagram demonstrates how circular revenues obscure that extreme cash burn. Major cloud hyperscalers invest venture capital into AI startups on the strict condition that those funds are immediately remitted back to purchase their own compute infrastructure. By acquiring direct equity stakes in these entities at peak valuations exceeding $1 trillion, the U.S. government is bypassing market price discovery. It is socializing massive venture capital infrastructure risks directly onto the public ledger. The long-term viability of these sovereign assets is dictated by the legal and regulatory guardrails that insulate them from political graft. China executes its corporate portfolio management through a deeply politicized, yet highly formalized, centralized bureaucratic structure in SASAC. The United States possesses no equivalent institutional framework for managing public equity portfolios. And recently, the U.S. outcome of Trump versus Wilcox. By eroding for-cause removal protections for independent regulatory agencies, the ruling invalidated 90 years of administrative law. The isolation separating executive political will from regulatory enforcement has collapsed. This creates an unpoliceable conflict of interest. The federal executive branch now simultaneously occupies the roles of dominant shareholder, regulatory policymaker, and political actor inside strategic corporate boardrooms. Without independent agency guardrails, U.S. federal equity vehicles become legally unmoored. This leaves them susceptible to the same targeted political patronage and opaque capital allocation seen in international wealth funds. The intersection of these two models reveals a shared structural flaw. Both state-directed capital structures generate systemic capital misallocation. The Chinese architecture drives a deceleration loop. Financial repression ensures perpetual industrial overcapacity, requiring a constant stream of deflationary export surpluses that trigger retaliatory tariff walls globally. The American trajectory forces fiscal and capital market erosion. By institutionalizing debt-financed portfolios, the U.S. subsidizes corporate inefficiency, crowds out private capital, and overrides fiduciary duty by weaponizing boardrooms with partisan ideologies. If the generative AI valuation bubble experiences a systemic downward adjustment, that financial contraction will transfer directly to the sovereign debt market, jeopardizing the structural integrity of the global financial system's risk-free anchor. To prevent a structural fiscal cascade, the U.S. apparatus must implement a rigid, multi-layered defensive framework. First, there must be absolute statutory separation. Independent oversight bodies require unreviewable jurisdiction over corporate compliance, antitrust evaluations, and financial auditing, insulated from executive intervention. Second, the system requires mandatory congressional capital clearing. Sovereign wealth platforms must be prohibited from operating via parallel executive vehicles. Every capital allocation must require explicit legislative authorization. Third, the deployment of federal funds must be bound by formal intrinsic valuation floors. This requires conservative multi-stage free cash flow models that strip away speculative premiums and circular revenues, ensuring taxpayers only back entities with proven positive marginal cash generation. Sovereign hybridization does not neutralize geopolitical risk. It transfers the mechanics of corporate insolvency directly onto the sovereign balance sheet. Substituting market price discovery with state intervention embeds insolvency into the sovereign balance sheet.